So welcome back, and now we will take about price patterns, and here we will combine a little bit of what we have learned previously and apply it to how to make sense of certain patterns, and you will see how nicely everything fits together. So the first and probably one of the most profitable patterns is the head and shoulders. It is very, very interesting to study this pattern. If you are new or if you haven't much experience, then this is a very, very good starting point. If you are experienced, you will probably say, oh, head and shoulders, that's a beginner and it's an amateur pattern. But this is not true. You need to get out of this mindset. There are many, many studies and books have been written about how profitable head and shoulders can be, because it tells you so much about the market. So let's look at this market here. We were in an uptrend, very strong uptrend. Then we have here our correct impulsive wave to the upside, and then what happens afterwards? Now the price seems to struggle. We only make it so far, and then afterwards we see quite a deep corrective wave. This corrective wave and this corrective wave, both corrective waves to the downside, signal or compare to what has happened previously. We've never seen such a strong so strong selling moves. And then here the next one as well. And at the same time we can see price made a higher high here, then here a lower high, and here again almost a lower high, or it's a lower high just barely, and then here again. The market is clearly rolling over, and this is what we call a head and shoulders pattern. For a head and shoulders pattern, you need on the left hand side you need two higher highs, and then on the right hand side you need a lower high. So this would be then the head, and this is the left shoulder, this is the right shoulder. And then at the bottom, when we connect the lows, this is what we call a neckline. The neckline of the head and shoulders is very important, because once the neckline is broken, it would signal a short entry. And you will find this pattern quite often. It is a natural way how the market moves. It is such a good way to visualize and think about what is the market telling us, where we go from higher highs and higher lows to lower highs with strong selling waves in between. Then we even break here and make lower lows, and then we start here this new downtrend. Very, very powerful pattern that is worth studying. You can find it across all the time frames, all markets. It's a great way to start with your pattern trading. Here's a little bit of a different pattern, or a little bit of a different head and shoulders. We were here in this clear uptrend, and then the market barely pushes higher. That is our first clue that something in the market is changing. And then here and on the right hand side we can see the market is making now a lower high. So after this little push higher here, the market was not able to make higher highs and made a first lower low. We have our neckline here. The neckline is always drawn where we connect swing lows. You can see that we have a swing low here, and then we break below that. We come back into this level, make a another lower high, and then afterwards you can see the market completely falls off, and the head and shoulders is often at the turning point of such market periods. One very important pattern and very effective one is either called a triangle, some people call it wedges. It does not really matter how you call it, it really matters what it is telling you. So you can see the market was in this downtrend here on the left hand side, and then here we started making a higher low. Also this was the lowest low, then we make a higher low, and then but it was struggling here at those highs. So here is a swing high, and here is another swing high, and here as well. But what do you see at the same time? At the lows are always coming higher and higher. And let me just quickly mark this one. So you can see the price keeps pushing into the same level, the buyers keep pushing into the same level, the highs are coming higher as well. So you can see that at this point then the market, it seems that there are more buyers interested right now. You can see the market is pushing higher and pushing higher. For now the resistance is holding, but it's just a matter of time. And then once you see that the price is breaking above that, it is closing above it, you can see then it starts a new uptrend, and this wedge or triangle is very, very powerful if you can see such a pattern. Here another one which I traded in my own trading. We have this strong, so we're coming again from this downtrend, then we start here this uptrend, but you can see here price is always, or 1 times 2 times here 3 times testing the same resistance. At the same time, the lows are always coming higher and higher. So every time the sellers try to push the market down, the buyers step in earlier and earlier to push price into the same level. And then it's just a matter of time. When will the sellers completely withdraw? When will the buyers completely take over? You can see that the market breaks out, even comes back with a nice pullback, and then here we take off to the upside. So a great way of visualizing price. And then here another one which I'm about to trade in my own trading. This is called a double top, or you can call it also, it's a double top with actually another signal which we call an exhaustion push. So you can see here the market was in a very strong uptrend here, and then suddenly the buyers just completely here lost the interest and the market was moving sideways. Many traders will get impatient and look for either premature breakouts here, and then they will caught here with those fake breakouts, or they will get into the mindset, okay, the bulls are here over, the rally is over, now it's time to get short, and then they will just bounce around in this pattern, in this rectangle phase. That's not good. You need to wait until the price is really breaking out. So wait until the price is breaking out and closing outside either the highs, then you can continue the long trade. If it breaks out to the downside, then you can start a short trade. Right now you can see here a few candles back we made this another exhaustion push, and now the price is rallying into the lows. Now the idea is you just wait until the price breaks out of such a range, because then it will signal that the market is making lower lows as well. And yeah, that's a very good way. And I'm just seeing here, looking at the bottom, what do we have here? Another wedge, maybe you've seen it. You can see that the market is always pushing into the same level here from the top. The lows are already coming higher, which means that each time the sellers try to push it down, the buyers come in earlier and push it higher and push it higher and push it higher. So you can even trade that with pullbacks, use the trend line. Once we have confirmed the trend line, first touch, 2 touch, here we have it confirmed. Look for the trend line pullback maybe, and then once we break out above that here with this candle, we start this new rally. So you can see patterns are very important. Again, the same rules with the trend lines apply. If you cannot find a good pattern with good confluence, which means that if you are struggling to find ways or levels where the highs are lined up, or you cannot really make sense of such a double top or a triple top, then don't force a pattern. There will always be a next trade. There will always be a next time where you have all the signals lined up, where you can easily make sense of your charts. There will always be a next trade. That's very important to learn early on. Remain calm. Don't force trades, stay patient, and your chance will come. You don't want to lose money on the patterns where you know you should not be in, and then you have to wait and make up for the losses with the good patterns. The ideal scenario is you skip the trades where you are not quite sure, where you cannot really make sense of the chart, and then you skip those. And then once you find a good trade where all the signals line up, then you can really capture the upside and make the profits. First, in this introductory video, I will show you what the elements of a candlestick are and give you a quick breakdown of how to read candles. And it's also important that we understand that, just like what we did in our previous module where we looked at the wave patterns, or where we looked at chart patterns, but we were able to break them down into their individual components. So we were looking at swing points, swing highs, swing lows, corrective versus impulsive waves. And we were able to use them to then look at patterns such as the head and shoulders. We were looking at double tops, double bottoms, triangles, and so on and so forth. This is also true when we look at individual candlesticks. We are able to dissect them into their individual components, and then we can use them to make sense of almost any candlestick, and then we will use them to time our entries, make sense of the charts, and find high impact areas. So when we look at a candlestick, we can see that there are only really 2 components. There's first the solid part of a candlestick, which is also called the body. The body is the difference and the distance between the opening and the closing price. So for example, a black candle shows that the price has moved down during the duration of the trade, the candle. The opening price is the highest price, and the closing price is then here the low of the body. Conversely, here a white candle shows that the market was moving up from the opening price where the body started to the closing price is where the body ended. Then we also have obviously here the solid lines. Those are called wicks or candle shadows, and those show the complete price movements during the duration of the candle. So right now this is the 15-minute time frame, so one candle represents 15 minutes of trading behavior or price behavior, and you can see that in this candle the opening price was here, but during the duration of the candle the price moved all the way up to this low of the candle. Then we moved higher up until all the way to the top of the candle where we left the wick, and then we moved down to close here at the end of the body. The next candle then opened here, we moved down a little bit, and then we moved higher and closed almost at the top. This candle then at the next candle opened here as well. The opening and closing prices are very close together, so we don't or almost have no body, just a very small one, and you can see the price fluctuated a little bit. So we have candle bodies and we have candle wicks, and those are very important when we understand and try to analyze a market. So for example, during a trending market like what we see here, you can see that the candles usually they close relatively close to the candle body. They don't leave long shadows to the upside or the downside. Sometimes they do, but more often than not, during a trending phase, you will see that the price is pushing into one direction with a strong force. You can see that here. Whoops, that's the wrong one. You can see that here in this period as well. The white candles, the bullish candles are pushing higher quite significantly. At the same time, it's quite interesting. You can see once the price moves into the top, the candles become smaller. That's an important clue as well. And we always need to put everything in context. Many traders, when they look at price candles or price action trading in general, they look at just a very, very small snapshot. But that's not enough. You need to put everything into context. We start here with a strong move to the upside, and then the candles become progressively slower and slower until the price action or the trend dies off and just moves sideways. And this is something we have to observe here as well. We see a good trend moves. We have strong trending candles here to the downside, and then here at the bottom it just dies off completely. No more trend direction. The candles are becoming small, long wicks, small bodies. So that's very important and something that you can already practice. Together, when we take it into combination with trending waves and swing highs and swing lows, you can already dissect your price charts in a very, very good way. So momentum is one thing that we can read from price charts by looking at how long are the trend waves and also how long are the individual candlesticks. Then another thing what candlesticks can tell you is a rejection of a price pattern or a price level. A rejection happens when you see a long wick at the end of a candle. And what does this tell you? It tells you that, for example, here the market was in an uptrend, the candles became slower here a little bit, and then the price pushed higher, but it was not able to close that high. The buyers tried to push price high, as we can see by the wick, but then the sellers came in and drove price lower. This shows a little bit of a rejection because the sellers stepped in and provided a little bit of opposition. And then here again, after the downtrend here, you can see the market was moving lower, left a little wick, although the body here is even pointing higher. So what does this tell you? It tells you that the candle moved all the way here to the downside, and then the buyers came in and stepped up and brought the price higher. Very, very strong rejection. We can see that even again afterwards. You can see afterwards the price did not immediately start a new uptrend, but we hovered sideways. The sellers made another attempt here to push price lower. They failed once again, and the buyers stepped in, drove price higher. This is a bullish candle, so we closed here at the top. Another strong rejection, and shortly after, not only was this the downtrend came to an end here in the range, but we also had here a move to the upside here with another final smaller rejection candle, and then we started this uptrend. Here in this pattern, this is very common that during range markets at the tops and at the bottom, you often see rejection candle wicks. That is very common. The buyers and the sellers are trying to test out who is here really willing to commit. Premature breakouts happen quite often. Those are indicated by wicks. That's why I already said that it's always so important to wait for a confirmed breakout. This happens then here, and then we start this new sell-off. So this is something that I really would recommend that you try to look at what else is quite interesting, you can look at, for example, look at previous swing points, previous swing highs and lows, and then try to see how are the rejections playing out. Do you see rejections, and what does this tell you about the market? Also look at trending phases. How can you combine trending wave analysis, corrective versus impulsive waves, and using then candlestick analysis. In the next 4 to 5 videos, I will now explore each individual candlestick pattern, the most important ones, and how we use them in the live markets to use them to time entries and use them to improve our chart reading abilities. Now we will take a look at our first candlestick. And the first candlestick is always, or it is the pin bar, because it is a very popular one. It can tell us a lot about the market context. At the same time, it is often used wrong, or trader apply it incorrectly. So that's where I want to address a few things and help you understand how to trade candlesticks, how to use the pin bar, and what to look for in candlestick trading. But first of all, what is a pin bar? A pin bar is usually a small candle, or a candle with a small body, and then preferably we would have quite a long wick. So roughly something like this in an uptrend, or conversely, if you have something like that with a long wick in a downtrending market. And what are candlesticks? What are pin bars? Pin bars show, as I already hinted, they are rejection patterns or rejection signals. And what do they signal, or why do they signal us a rejection? Let's, for example, look here at this candlestick here. This is a classic pin bar. You can see the price was moving higher and higher, and then suddenly we see such a rejection. The price tries to make a new high. It tries to break higher, but in the same candle, the sellers step in and reverse the price almost to the bottom. You can see the closing price is very near here, the opening price just below that. So it means that from the opening price, the price moved up, and then in the second half of the candle, the price moved down and closed all the way here. So a classic pin bar, and it shows you already that although there were quite a few buyers at first, then the sellers took over and reversed the price. Now, a big problem that many traders have with pin bars is that they enter as soon as they see a pin bar. So in this context, they would enter a sell trade as soon as the market closes the pin bar, and this often leads to wrong assumptions or wrong trading ideas, and often you will get a loss using a trend line pin bar this way. Because a pin bar is not a strong enough signal on itself, there is a pattern which we will get to know later. It is called a hanging man, which can look quite similar, and it is the exact opposite signal. In this case, if the price would print this, if we didn't know what has happened afterwards, it could as well just be a continuation signal. So we cannot just trade a pin bar, because we will often run into failed breakouts. So the first rule of a pin bar is that we only trade triggered pin bars, which means that we look at where is the low of the candle, which is in this case here at, let me delete that, which is here in this case the low of this wick here. And once this low is broken, then generally that's the idea where you enter a pin bar, because it confirms that the momentum is with the candlestick. Here we have then another very interesting pin bar example. It is just a few candles after. You can see afterwards the price moved a little bit lower. Eventually we found support here at the previous swing low. Very nice context here, and then the price moved back up again. We broke above the previous highs here briefly, but the price did not have enough buying power. There were not enough buyers in the market to continue the uptrend. We again leave a pin bar. A strong wick to the upside indicates that at first the buyers tried to rush into the market, but then the sellers came in and reversed the price immediately. And you can see afterwards the price then turned into a stronger downtrend. And here again, when does the price trigger the pin bar? It is here basically on the open of the next candle, because the open is already here well below this closing price and below the pin bar. So first rule is that you should always wait for a triggered pin bar. Never just blindly trade a pin bar. That is very important. Also, to increase the chances of successful pin bars, you should always trade them at a market or with market context. So you're not going to trade blindly every pin bar here wherever it pops up, but you look for market context where it actually makes sense. For that, we have taken a look at support and resistance previously. This is the same chart that we drew together earlier in an earlier lesson when we were looking at support and resistance. And now you can see why this comes in handy. For example, here's a little pin bar just at this flip zone. Let me zoom in a bit. Here you can see the price broke through this support and resistance area here. We came back into this area, then we posted this pin bar. This pin bar now shows that the market is trying to break higher, but the sellers are defending this price level. They don't want the price to make a new high. And so this is defended by the sellers here with the pin bar. They step in, and then they drive price lower here afterwards, after this pin bar. So this is a nice rejection, and you can also call this a retest pin bar. Very nice confluence and a good way how you can structure your trades. You don't trade pin bars or any candlesticks for that matter, or randomly wherever they pop up, but you always look for where does the candlestick actually make sense at support and resistance, at previous highs and lows, and you don't just blindly trade them. Here, for example, is a good pin bar where we have a pin bar. You can see that here price moves up after this uptrend, then we close here, but you can see the next candle never triggers this pin bar. If the next candle doesn't trigger the pin bar, you should really think about the market. Do you really want to be short in the market? Preferably, you will pull your limit order if you're going to enter with a limit order, or you at least decrease the position size. So you can see here, the next candle did not trigger the pin bar, and in such a case, I would prefer to wait for another signal and not get too hung up on one signal or one candlestick. As I said, there will always be a next trade. There's no real need to get too attached to one single trade. There will always be a next trade. Here is another nice example where we even have a double pin bar. So let me go through this very nice chart example here together with you. Let's zoom in a little bit, and you can see the price was moving lower and moving lower. Here we're coming from the left hand side, and then we see here our first pin bar. After a strong price move, price barely broke through those previous lows. So that's already, as we know, when the price struggles to make a new low, or when it just barely breaks the low, then this can already be a sign that the market is not as strong anymore. Also, when we see such deep correction waves, that should really set our alarm bells off. And you can see we post a pin bar. Again, this barely gets triggered here. We don't really close, or we don't really push into a new high, just barely make it. And what happens? We even make another pin bar. So this is very interesting. If the first pin bar doesn't get triggered, but the second pin bar, the second candle afterwards, or the first candle afterwards is also a pin bar, this really reinforces the signal. It shows that, okay, the sellers in this case, they are stepping in once again, trying to make maybe a final attempt to continue the trend to the downside, but again, they're failing. And if then the market, or if then the next candle breaks, this could even be a stronger signal. We will see that later when we take at divergences. There's a concept called double divergence. If you have two signals right after each other, they can reinforce themselves if it gets triggered. If the next candle wouldn't have triggered this one, I would have probably stayed away from it because there is not really any clues, and the battle between the buyers and the sellers is just too intense, and you don't want to get caught in the middle of that. But you can see here afterwards the price broke the candle here and broke the pin bar quite significantly, and then we started here this strong uptrend. So that's a very nice signal here where we have a double pin bar. Here another one, we just scroll a little bit forward, and you can see we were here, we had our previous support, and then the price moves back into this. It fails to reach the absolute low, but you can see we make a little bit of a pin bar, and you can already see that after this strong drop, before that price already slowed down significantly, and there was not really a lot of selling support in this market. Then we have the little pin bar here, which shows, okay, the sellers try to make a final move, but they got rejected. And then the next candle, the pin bar breaks here, and then we shoot up and start this nice uptrend. Then we can just follow the price, and you see we have here our previous high. And as I said, previous highs can be a very, very important point as well. You can see the price is trying to break out. You can see that here at this point it even looked like quite a strong breakout, but then the next candle shows here a pin bar. It shows that maybe the breakout after all wasn't that strong, and maybe it was just a final last attempt of the buyers to mobilize all the strengths, but they failed. The seller stepped in. The next candle after the pin bar was or did trigger here the pin bar, and then you can see we don't make a big move, but this is already good for a small trade, a little profit, and always take what is safe. And the pin bars can help you get into such trades. Later on we will learn anyway how to manage such trades, how to move a target, how to set targets, how to manage a trade. So let me share one last example maybe, and then I think it becomes clear how to look for a pin bar. And here is a pattern which I really like to trade or like to observe as well. So here we have a pretty well defined range, I would say. We have a clear boundary to the upside. We have quite a clear boundary to the downside. And if you have such a pattern, look for pin bars or any other confirmation signals that we will learn at the extremes. Also, you can quite nicely use pin bars at trend lines. When you see a pullback into a trend line and you have also a pin bar, this can be quite nice. So first of all, here at the bottom we do have a small pin bar. Once the price moves back into the previous lows here, you can see that the candle just touches it almost perfectly to the pip, and we leave a pin bar here. And then the next candle, it triggers the pin bar. It does not take off immediately, but you can see eventually we make our way back up to the top and have a nice uptrend here after the pin bar. Then here is another very important one. It is sometimes referred to as a trap pattern or a squeeze. You can see we are breaking out of this pattern. It looks like the market is ready to start an uptrend. But when we zoom in, what can we see? Just two candles afterwards, you can see we have a huge pin bar here. First, this is not a real pin bar because the body is not really small. But then the candle afterwards, this is then the pin bar that we need as our clue. You can see that the price moves higher, gets rejected, closes here at the lows. The next candle triggers it barely, but it is moving a little bit lower. And then afterwards you can see we don't only drop to the bottom of the range, but we start a completely new downtrend. So this is a very important lesson as well, and a good example where you can use a pin bar as well. So you can use them, as I said, as a support and resistance retest break. We can use them in pullbacks and ranges at previous highs and lows. When we see such a failed breakout or a trap pattern, they can be very, very great confluence signals. Maybe one more signal here, because I just found that in the markets here, and you have here a very well defined support area. Here is, we have a low here, not too significant, but here it is quite significant, a strong turning point. Those are always important to be aware of. And then the price comes back into the level with a strong drop. Just imagine how it looked like at this point when the candle formed. It probably looked like the market was ready to break out and start a complete new downtrend. But then what happens? The next candle, or in the same candle, the price reverses, closes here, and then the next candle breaks this with this pin bar, and then starts here a nice move to the upside. So you can see pin bars are very good when you trade them at confluence levels, previous swing highs and lows. They can add a lot of context to your trading signals. And so I think we can conclude that the pin bar is a very interesting one. We will now look at a few other candlestick patterns, and in the next module we will take indicators to the mix and see how we can use indicators as well to improve the quality of our setups and our trades in general. Now we will talk about the candlestick pattern called Engulfing Pattern. This is a multi-candle pattern, whereas the pin bar is a single candle pattern because it is only one candle. the engulfing pattern consists of 2 candles. How does it look? The first candle is usually, well, it's relatively small compared to the second candle. And as the name suggests, the second candle completely engulfs the first candle. So this is a momentum candle where you can see a sudden change in momentum. The first candle is small, and then suddenly the second candle shows a huge injection of momentum. And it can be used for a variety of setups or signals. We will see how it can be used as a reversal candle, where a new trend is initiated after an engulfing candle. It can also be used as a trend continuation and as a breakout candle. So there are many ways how you can use that. And just as we did with the pin bar trading, it is important that you don't start hunting engulfing candles or any candlestick for that matter anywhere or at random places. If you want to improve the quality of your trading and the quality of your setups, you should only trade candlesticks and signals in general only at high impact areas. What are high impact areas? Let's recap. Those are mainly at trend lines, so you can use pullbacks, trend line breaks, but also support and resistance areas or previous swing highs and lows. Those are very important high impact areas. And a trader who avoids trading signals that happen at random places on his charts and only trades the signals and the candles when they happen at high impact areas can often see a huge improvement. So let's go through a few examples of how to spot engulfing patterns and how to read them. So here is a very nice example. You can see the price was in an uptrend. We started to make a higher trend here. Did not really succeed yet, and you can see price chopped sideways. Here in this area we have a very clearly defined pattern and a clearly defined support level, because the price always struggled here to get into this level or to break through this. We saw a little bit of a push higher afterwards, and then price immediately falls back into the level. That's quite interesting. And what we see here is then our first engulfing candle. Let me just mark that for you, and then I will talk a little bit about that. So you can see this is the engulfing pattern. The first candle here is relatively small. The second candle is quite large. It completely engulfs the previous candle. We have a wick where we test the lows once again. The sellers, though, run out of steam. You can see they tried to push the price lower below this support level. They eventually ran out of steam. The buyers stepped in, took the price from all the way at the bottom and closed then here to the top. This is a strong engulfing signal, a strong signal that the sellers don't really have that much control in the market. And then when the engulfing bar breaks, just the same rule applies as what we talked about on the pin bars. When the price then makes a higher high, we close or we move above the engulfing candle here, then this signal is triggered as well. And you can see how the price continued, then it's moved to the upside. A nice little profit here on such a pattern. Here is another very nice example. We have a previous swing low here in this market. You can see here a little bit, but here we have a clear low. And whenever we see such a strong turning point, what we do is we just draw a level or a line, and then we wait until price is coming back into it. And then we will wait to see, can we get a signal? Not always will you get a signal at such a level. Sometimes price will just come back to it and then take off again, or it will just break through the level without giving us a signal, and that's totally fine. We will have plenty of trades. We don't need to force them just because price is at an important level. But here it's different. You can see price hovered a little bit around that, did not really find any impulse to either move lower or higher. You can see the candles do have quite long wicks, which means that there is a lot of buying and selling going on, a lot of testing of the level. The sellers tried multiple times to break the level. Here we have a strong bearish candle, once again trying to close very low. This closes lower below all the lows. We have not cleared the complete wicks, but we have closed below all the previous closes. And then what happens in the next candle is quite the contrary. Now it seems like the buyers suddenly rush into the market and drive it up. And again, this is then an engulfing candle happening at a key impact area after a lot of buying and selling going on. This candle closes above all the previous highs as well. and it completely engulfs this previous selling candle. And then the bar gets triggered here once we break above the high of the wick, and you can see a pop and we shoot higher again with this signal. So another one here, and you will see that they happen quite frequently. We have here a previous swing high. Here maybe this is not too much confluence, but we see that this has been a turning point here before as well. The second turning point, and here is then the final turning point where again the price tries to move into the level. It finds resistance, and it does not only find resistance, but it finds resistance with an engulfing bar. This time it is not super strong, the candle, the engulfing bar, but it still engulfs completely the previous buying candle. You can see that here, a very strong candle. It gets triggered. It has a little bit of troubles here, moving lower at first, but it never really comes close to the previous resistance anyway. And then you can see how the market sells off afterwards. And all is initiated by this little engulfing bar. You can see previously here was even a pin bar. So at this level there seems to be a lot of buying and selling going on, and a lot of sellers always rush into the market here at this place. So this is also an important clue that will help you improve your chart reading abilities. Then here once again we have a nice support level here. We can even probably extend that to catch more price action. You can see here, 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 here as resistance, here as resistance, here as resistance. And what do we see? How is the price moving into this level? Yes, you probably have guessed it. We see that the market is making higher lows already, moving into the level again and again here, and then finally here before the breakout happens. And then let me zoom in a little bit. You can see that we are already pushing into the level earlier and earlier and earlier. This is what we have called a triangle or the wedge. You can see that if I just draw it like this, and we just look at the lows here. So clear triangle, we push into the level, we break out, and if you don't catch the breakout, that's okay. Don't chase the price, wait for the next signal. The next signal here came, fortunately, and it was a classic break and retest pattern. You can see that the market moves up here in this candle. It stalls a little bit, comes down back into the level. We retest the previous high here at this point. This is something that will happen so many times. You will, once you start looking for those patterns, you will start seeing them everywhere. A break, retest, and then we take off again. And how did the retest happen? Yes, that is again an engulfing bar, where this white bar, the bullish bar, completely engulfs the previous selling bar, and then once it gets triggered, it shoots up. It confirms that the level is holding. The sellers cannot penetrate the previous highs. They cannot dip back into the range, and then the buyers take in with this take over with the engulfing bar and then start this uptrend. And you can see here we drift higher, then the price drifts sideways and the uptrend is over. We have here a little bit of a support and resistance area, flip zone, a little bit here, price comes back into it. Then again, we break below that, we come back into the level, into the area, we retest it. But how does a retest look? Again, it won't happen always. We won't always get a signal with a retest, but often we will get one. Just as in the previous lesson, we learned that pin bars can be a retest pattern. Now engulfing bars can be one as well. You can see the price, first it looks quite strong moving back into the level, but then here suddenly the candle size drops off significantly. We only have small candles, no real buying interest. The buyers are not really that much interested in the market actually, as we can see. And then here, once the price gets high enough, the sellers say, okay, now it's the time to initiate the short. This is again a small engulfing candle. It is almost engulfing here. And then you can see once the level breaks, the market sells off and starts this completely new downtrend. So a little bit of context here can help you improve your chart reading significantly. Another very interesting scenario here. This is one of the support and resistance setups that we drew in an earlier lesson. You can see that here and here, very strong resistance level. And then when we follow the price again, just look first at how the price is moving into the level. We are making higher highs. And then once this level is reached, you can see price is struggling for a little bit, but look at the initiation and look at the breakout candle. The breakout candle is, yes, it is an engulfing candle. And the engulfing candle is showing us very, very strong buying momentum here at this resistance. You can see price moves higher, struggling a little bit here first, then it picks up momentum, here a little bit of a pause, and then boom, we shoot up and confirm the breakout. We close above the highs, and then the uptrend is resumed and continue to the upside. So a very, very nice signal once again. Let's look at maybe one more example, and then I think it will become clear. We have here an interesting support and resistance area. You can see that a lot of reaction. Then we come back to it, and let's take a look at how we come back to it. First, the price drops very strongly into the market. This is a signal where you would expect a breakout, obviously, and a continuation. But the price never really breaks out. We never make it below this low here. So the sellers are not really that in control of the market. And you can see a lot of wicks going on. As I said, a lot of wicks mean always a lot of buying and selling, battling going on. The buyers and sellers are trying to figure out who is in control, who's ready to take control, who's ready to make the next step. And the next step is, it takes a long time. You can see the sellers are trying to make a last attempt, strong selling candle, and they never really close below the lows. That's very important here as well. The sellers, although they try to make it look like it's quite strong, they fail, and then the price shoots up here. It leaves an engulfing bar to the upside, very, very strong, sudden buying momentum. Then we break into the level. Just look at this time. Again, it's a break and retest. So if you see that you get into the trade here when it's triggered, price moves up a little bit, comes down, don't get scared about that the trade will fail. Of course, sometimes it will fail. It doesn't always have to fail, but sometimes it will fail. But in this case, you can see the level is holding. It is a retest. A break and a retest is a very common pattern that you will often see in the market. So the market comes back into the level, tests it as support, holds, and then we see a pop back into the previous highs here. So very nice setup. And just look at here, what do we have here? A pin bar penetrating the previous lows, then of a strong rejection. And this is a great pin bar signal. You can see we break above the highs afterward. You can see we break above the highs afterwards with the next candle, and then this huge uptrend starts to the upside. And yeah, it's all started with this pin bar. Previously, the engulfing bar started this one. So you can see the engulfing bar is a very versatile candle. You can use it for breakout trading. You can use it for a continuation, or when the market is turning as well. And try looking for the pin bar and the engulfing candle in combination. The next pattern that we will look for are doji based patterns, which are also great patterns, and I look forward to welcome you in the next video. So welcome back to the third candlestick pattern, and now we are going to talk about dojis. And dojis are quite important. They can tell you a lot, and especially the doji patterns which you are going to learn here. They are multi-candle patterns, so in contrast to pin bars, which are one candlestick patterns, engulfing bars are two candlestick patterns. A doji, or the doji patterns that we will learn here, are three candlestick patterns. So we get more explanatory value because we analyze more price action at the same time. That is great, and it can improve the quality of our trades and the quality of the signals, obviously, as well. Furthermore, the same rule applied to doji patterns as also on engulfings and pin bars. We don't trade them at random places, but we always wait for a pattern and a signal to form at a high impact area. So what is a doji? A doji, as I said, or the doji patterns that we talk about, there are three candlestick patterns. For example, in an uptrend, you have a large bar moving higher. Then a doji, as definition, when you look at a doji definition, it says that a doji is a candle with a small or almost non-existent body, something like this, and small or long wicks. The wicks, they usually stand out. They don't have to stand out. Let me use another one. but that's usually how the doji looks like. Small body, sometimes a large wick, sometimes not. Usually the wick is equally long to both sides. That's the signal of a doji. And then the next candle in this case is going to be a strong downwards candle. So what does this tell us? We see that the market is coming up quite strongly. Then it is pausing here with a doji. It shows inactivity. A strong buying and selling is usually going on. The buyers and the sellers try to battle out who is going to make the next move, who is stronger in the markets. And then the next candle confirms with a strong move, usually downwards, that the bears in this case have won. Obviously, there are also candlesticks in the opposite, or doji patterns in the opposite direction, where the price is moving lower with strong selling. Then you have a small doji pattern here, and then it shoots up on the next candle when it becomes obvious that the buyers have gained control and are the dominant force in the market. So that's a 3 candlestick pattern. It's very important and a very good and reliable one. Here's a very nice one. You can see we have a strong turning point, a very strong turning point where the market goes from up to down in just 2 candles. And then we just wait for price to get there. And here we have a classic doji pattern. Sometimes when you want to Google for it, it's called an evening star. Why is it called an evening star? Because the price shoots up here. Then this little doji is then the star, where it is just a small candle, looks a little bit like a star. And then here it goes to the downside. So the doji pattern is a little bit on top of everything. That's why it's called a star. Doesn't really matter, but I just thought I'd throw it in. And so you have this doji pattern here. The market is rallying strongly into this previous high, and you will just wait what is happening. We're not going to get in a trade just because there's a level. That is how the amateurs trade. It's a dangerous way of trading because we don't have any confirmation, we don't have any read on the market. We need to wait what is happening here. And you can see the next candle after this doji is completing this evening star pattern, where the market turns on the spot, moves lower, confirms that the buyers are not able to push through the previous high. The same thing is happening again. There's a lot of selling interest, as we've already seen here, and then the market turns completely and starts this new downtrend just from this little pattern. And then of course there are, again, as we discussed it, there are retest or re-entry signals here along the way. So even if you missed the first one, you can often find re-entry and retest patterns, because the price and the trends often they walk or they move in those stepping stone behavior, a break, retest, a break, and a retest. And then you can see even here a small evening star pattern is visible here at the previous highs, and you can see that how the market behaves and how it moves. Here another very interesting one at a daily chart. So again, you can use that on all the time frames. Just make sure that you are very selective. Don't trade them anywhere, just trade them at high impact areas with good confluence. So here you can see the price is moving down strongly into this, again, high impact area. Then you can see the downtrend is quite strong, 1, 2, 3 strong candles in a row. This candle closes at the absolute low. Usually it's a sign of good weakness, a lot of selling, but then the next candle stops that here on the spot, and the next candle is then completing the evening star pattern. And afterwards we don't immediately take off, we come back into the level and then move higher. So that's also one thing. Not always will we succeed right from the get-go. Sometimes we have to sit through drawdown, but this trade worked out immediately, or eventually I should say. We are never breaking past this low, so we are never violating this rule that the market has to make higher highs and higher lows. It's never breaking the previous low, and we keep making higher highs, and that's started by this doji pattern. Here is another small one. This is especially interesting because it is with a gap. So we have our previous swing low here, where the market goes from super strong selling off to a strong reversal. So this is a high impact area. A lot of buying and selling is going on here. Then the market comes back. It does not quite make it, but it almost makes it. So that's even if the price, sometimes it will overshoot the level, sometimes it will come short of the level. That's totally fine. And then you can see here we have a gap. What is a gap? The price closes here and then opens here on the next candle, which then creates this gap where you don't have any real trading activity visible. It happens in overnight trading or on weekends. And then you can see here the next candle reverses strongly to the upside again, confirming the evening star or the morning star, whatever you want to call that. And then we start this rally here to the upside after reaching almost reaching the previous impact area, showing this Doji pattern. Another interesting one, we have seen a similar one before with the engulfing pattern. The market drops like a stone here into such a level, then a lot of candles with strong wicks, a lot of buying and selling going on, a big battle between the buyers and the sellers, trying to figure out who is in control. But you can see after this drop, the sellers really never regain. We see one last final attempt here, which then at this candle, this is the Doji, it stops that here at the previous lows. The next candle again confirms then this super strong evening star or morning star pattern, and then we shoot higher. So again, you can see how we can put this into context. The drop, suddenly there's no selling. The buyers and the sellers battle out who's going to make the next move. The sellers tried once again but failed to break the lows. Then here the Doji, and then here the immediate momentum push to the upside with strong buying force. You can see the evening star or the morning star, the Doji pattern here. It's a very important one. With the help of 3 candlesticks, we can make already a big improvement in our analysis, and this is going to help us in our trading a lot. Let's maybe take a look at 1 or 2 more. You can see we have a swing low here, a very important turning point where the market started this nice rally here. Then we come back after some time. Let's zoom in a little bit. Again, the market stops very, very strongly into the market. Here we have a strong candle. The next one is a Doji with a longer wick, showing again a little bit of rejection. And then here the next candle is a Doji, or it's confirming the evening star or whatever you want to call that. It does not take off immediately. You can see we hover a little bit sideways. If you're not comfortable with such a trade, that's totally fine. Cut the trade, wait for the next one. That's something we will learn later on. And then here, interestingly enough, I think that's the example we took a look at earlier. The market just hovers sideways. It comes back into this support area, posts this pin bar here, and then starts a little rally here of that. So very interesting. You can see how we can put it into context, follow the price action with what we have learned quite effectively. Okay, the last one for this lesson, and then I think it should become clear. We have a strong swing high here. We come from this rally, then the market stops and sells off a little bit. We come back into the level. The buyers are trying once again. Maybe we can continue this uptrend, but at this resistance level, right on the resistance, you can see a strong buying candle first. A little Doji here. This time we have a stronger body, but still it's not significant in comparison to what we have seen here previously. The next candle here is then confirming this evening star Doji pattern with strong selling reversal, and you can see what happens afterwards. A strong drop after the top. Okay, because it's so nice, one more example, a strong move to the upside. You can already see that here the battle between the buyers and the sellers is intensifying significantly. We see increasing wicks here at the top, and then the price makes a double top. At this point, we come back once again into this area. We make a little rally, have this Doji, and then on the next candle, we immediately sell off, super strong sell off here with this pattern. And we do sell off here a little bit further. A little lesson on target placement, exiting trades. You can see here's a strong support level in this area. So the price drops after this evening star from here to here. We come back once again to retest this pattern, retest this area in this way, and then you can see we continue to move to the upsides, to the downside. So everything fits together here quite nicely. We have a double top here after the intensified battle. Then we have this evening star reversal pattern, a break here, and then we drop back into our target, into this support and resistance area. We come back, make a retest of this area, and then we sell off finally and eventually completely. So the evening star is a very good pattern. It can be used in combination with the previous concepts that we have learned, and especially in the next module when we start looking at indicators, we can also add Doji patterns and any candlestick pattern for that matter to our decision-making process to improve the quality of our setups.